All right, I'm back from my vacation over this past week, and I left the market with you in good hands, and the market didn't do so well over the past, to say the least, over this past week. Didn't do so bad the last couple of days, but before expiration, really a down move, and then today continuing that down move. We're going to break down this correction that we're starting. We left kind of with that idea that we might be starting a correction. We might just be at deep pullback. It depends upon what we do with that bear tag. But it failed, and now it looks like we're in correction mode. So I'm going to talk to you about what are the other signals that are creeping up like just now this week that kind of confirm that we are in a correction mode. Why it doesn't appear to be as volatile as it did last year, 2022, last year during that correction and other corrections, and how this one might end up going with a pretty decent analog comparison of another correction that this might behave very similar to at a very similar time of year. So I'm going to break all that down, what's driving this price action, why it looks a lot different in what's driving this price action this go around than it did before in September. A little different here this time, pretty risk off. I'll show you that. And then our trade idea is a classic setup that's got a very, very poor margin of safety and setting up for a decent bearish trade to the downside if this all plays out. And I'll show you what that is. So let's go ahead and get started. Today is Wednesday, October 25th, 2023. This is the market outlook from marketscholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow us on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including the Market Outlook live video I do every day at 3:30 Eastern time. I do the Market Outlooks. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button. Again, the goal is always to get to 100. And this has been out there for a whole week. In fact, they had like 4,000 views on the tweet and only got 76. So let's try to get it up there to those triple digits. Again, thank you to those who like it day in and day out. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. All right, let's go ahead and get started with the S&P 500 on the market forecast indicator like we always do. So this was the last day. I did the market outlook on the 17th, on that Tuesday before I left on vacation. We talked about the likelihood that bear tag would fail, that the odds are higher that it would turn into a bullish move, but we expected that it would most likely fail to the downside and shoot. The very next day, the first day I'm gone, the first 3 days I'm gone were all down days. Boom, boom, boom. And then yesterday and the day before on Monday, kind of rebounding after expiration before today, closing at its lowest levels of what you can pretty much now call a correction. It feels like now the S&P is now in correction mode as we are making our way towards potentially below the 200-day moving average. You'll see here in a minute, and towards the 200-week moving average. That is what you would deem a correction. Getting to the 200-day moving average is just a pullback. We have done that, and we did it here, and then we bounced off of it and failed, and now, with our failed pullback bounce, and now we are in correction mode. The intermediate line had dropped below market sentiment. We talked about that potential bearish peak, near-term peak. That obviously ended up being the bearish peak, and short-term sentiment was really bad at the end of the last week going into expiration. And then you can see how things ended up here today. The intermediate line is well in the reversal zone again. Market sentiment line still falling in bearish territory. Short-term sentiment still bearish. I mean, this is it's not a good thing. And the NASDAQ finally kind of joined the party here. If you notice, well, let me go back really quick to the S&P. Because the S&P today kind of broke some important Fibonacci levels. You can see that last week we had broke back below that 38.62, the 38% Fibonacci of this intermediate rally that we're retracing, and the 62% Fibonacci level of the correction of 2022 correction that we've been retracing to the upside off those October lows. Well, We broke back below those levels, and now today we broke below the 50% retracement of the intermediate rally we're correcting. We talked about that before too. That when you correct, we bottom out on top of the 50%, it's most likely a pullback. But when you bottom out below it, it's even below, whether it's 62, 78, 100. Deep pullbacks can get to 62, but once you get below that, now you're in correction mode in this area down here, which appears like that's where we're headed. You also notice we broke below the 23% retracement of, which is that 4,200 level of the post-COVID rally, right? So the rally that peaked at the beginning of 2022 that we had dropped below. So if I were to zoom out here, you can see we had dropped below it, and we had finally broke back up above it here earlier this year, only now to kind of get back below that. So these are important levels. You can see that 50% retracement of the correction is right here too, or right around 4150. So these are really, really important levels for the S&P to kind of hold over the next little bit if we're going to really avoid, an extended correction like we saw here, which I don't think we will be able to. But if we are going to, we kind of need to hold here. If you take a look at the NASDAQ 100. Obviously, you finally are back to dark pink shading and a red line there too. Intermediate line is back in the reversal zone, back below market, cross below market sentiment. The near-term line formed a bearish peak here yesterday. Is already coming back down with bearish short-term, bearish and momentum line. And you can kind of see here too the Fibonacci's that we're seeing. Again, same thing. We remember the S&P broke below the 50% retracement of the intermediate rally, which is down here. And it broke below the 23% retracement of the post-COVID rally, which is a little bit higher. So this is a really important level for the NASDAQ 100. You break below this 1,400, 350 plus or minus. You break below this level, and then you are clearly in correction mode on the NASDAQ. Obviously, we have been in correction for the Russell. As you can see, we are clearly to the downside here. We broke below... the 23% retracement for the post-COVID rally is way up here. The 50% retracement for the correction, 2022 correction, is way up here. This intermediate rally from earlier this year, we've already gone below the 100% level, like full-on correction mode. In fact, we almost got a cluster here today, another cluster. The near-term line finished at 2138. Otherwise, the intermediate lines below the 3rd percentile, that is extremely low. So it's back below the 5th percentile. Very extreme. And we had multiple clusters last week. So we've had, during this intermediate decline, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 clusters during this particular intermediate decline. That's a lot. We didn't get that amount on any intermediate decline during 2022. In fact, we'd have to go way back to find one intermediate decline that's had that many clusters. Very, very significant drop on the Russell 2000. And for that matter, the Dow Jones as well. Now, the Dow didn't fall as much today, but you can kind of see just how bearish it is. Same as what we're seeing. Dark pink shading, failing, the bear tag failing like it did earlier. It's clearly bearish here. What stands out for the S&P and what we talked about before I left was if we end up with this kind of 3% type move, it ended up being about 2.33%. Volatility is really low right now, but that's a big move to the downside there last week on the week of the bull tag, and now your short-term sentiment is both at extreme lows. The intermediate lines crossing below market sentiment. In fact, this is the lowest crossover. Usually when we get the bull tags, like we did over here, the crossover either occurs in the upper reversal zone or at least in bullish territory. This crossover occurred just below bullish territory. It didn't cross over last week. It's crossing over this week. But even last week, they were both at those levels. And you can see now this week, we are finally breaking below that 2.5% mark that we didn't do in March or in December on the last two intermediate declines. So this stands out as something very significant. A bull tag that we didn't get over here, a crossover the intermediate line below market sentiment, which we didn't get on either of these two, and breaking the 2.5% level. what's even scarier, I mean, we're talking like Halloween type scary levels here, is the monthly market forecast. We're getting a bull tag on the monthly market forecast, which, in and of itself, you get a bull tag in every correction. We got one over here in 2022. We got one with COVID. We essentially got one in the fourth quarter 2018 and 15 and 16. Like you're going to get a bear tag pretty much every time, a bull tag, excuse me, every time you get a correction. And you tend to bounce off of them. That's why the Tom Lees of the world, that's why he comes on TV, because more often than not, corrections bounce back up. You get these bull tags, you just bounce right back up. The very next month, essentially. Almost all of these. 16, it took about another month. But you essentially, when you get these kind of bull tag type levels where you close slightly below the 30-month moving average, you bounce right back up, right? So until you don't, right? Which is what happens when you get these bear markets, like we saw there and there. And then you go back out to, and you can see even 1987, you bounce right back up. 1990, you bounce back up. These were kind of some recession. At least 1990 was a recession. Didn't quite produce a bear market. 94, 95 was a soft landing that we get, that's commonly referred to here. So you can see a little bit of difference now between them. 73, 74, you can see that bull tag. But I mean, even that bull tag occurred at the bottom. The crossover occurred at the bottom of bullish territory. All of these. This was the last one, 78, 79, where the crossover occurred below there. Again, you can see just how bullish we had gotten. This is a little different story. We haven't been that bullish, right? This is kind of an extension of the bullish trend that we've been on. We had these bull tags that bounced up immediately every time. We got a bull tag, we bounced up. We got a bull tag, we bounced up 2 months. We got this bull tag, we bounced up. And we bounced up immediately every single month. The difference is, look at the short-term sentiment. I mean, if you follow my cursor over to the left, and I'm going to go, this goes all the way back out to, since there's been a 500 stock index, look at the near-term line. This is as low as it's ever been. Now, we have a week left. We have 2 days. We have a week. So it's not, we can bounce back up here. We can have 5 good, really strong up sessions, and that can change the story. But as of right now, that is the most bearish short-term sentiment that we've seen. Since 1958, the combination of the momentum line, the near-term line, coming with the bull tag crossing over, with the intermediate line being below market sentiment. See, all these bull tags, you kind of like either they were already up in the reversal zone, or I mean, the intermediate line's been below market sentiment this entire time. That's why I said, if you go back to 78, 79 here. The intermediate line got back up above the market sentiment line. Then you had that kind of cross over here, or over here especially. It got back above market sentiment. It did not get above market sentiment this go around, and we're already faltering. So I mean, that is like keep you up at night, Halloween type scary chart here if it holds. I've been on record that I believe that we will, that we are headed in a correction. I've been on record to say that I believe that this correction will lead to a bear market eventually. It will take months, but eventually it will lead to that. We're not going to fall in the bear market tomorrow. That's not how this works, right? I know we all like to think that 1987, I saw a lot of tweets over the weekend about Black Monday, right? We're going to have another Black Monday. That's not how this works. That's not how bear markets work. That wasn't even a bear market. That was just a one-day crash, and you saw, like even over here, that the very next month after that bull tag, we bounced right back up. So we were just insanely bullish, and it was just a kind of clearing out some insane speculation there. So we're not going to have that this go around, but we are most likely headed into a correction that will ultimately be the precursor to the bear market. I believe that's the case, and that's kind of what the market forecast is telling us on a long-term basis. Even if in the short term we might get a few up days, as we get further away from that moving average, you're going to move back towards it. We've already seen it twice on this current intermediate rally. But whether like the Russell 2000, it doesn't mean that we have to get all the way up to it, as we've seen here. We only got up to it once. The other times we didn't come close to getting to it. That goes to show just how bearish we've actually been. So long segment there on the market forecast, but yeah, I mean that kind of shows what kind of market we're in. And for other, like if we're looking for other signs that we're actually in a correction now, where the weekly candle is crossing below the 200-week or the 40-week exponential moving average for the first time. PPO is falling, clear bearish signal down there at the bottom, a clear bearish candle on the Hakinyashi candle. Obviously, 3 red arrows across the board. After 1 or 2 days of greens, didn't get a single day on the Russell 2000. I mean, those are really bearish when you only get the 1 or 2 days. We're breaking below the 200-day moving average on SPY, which means as we move towards the 200-week, as you break below the 50-week and work towards the 200-week, then that's correction. That's filling in this gap between the 50 and 200 is what corrections do. You're negative on the weekly MACD. The stochastics is very bearish. I mean, as I already mentioned, we're breaking important Fibonacci levels. I mean, this is a bearish pattern here. You're looking at the DMI. It's bearish. We're just barely above 30. We're not quite below 10 yet, but it's pretty. I mean, that's a pretty low level for the daily DMI. The weekly is just getting started, right? We're not even above 25 yet on the weekly, like we got above it over here during the correction, and we're just barely below 20 on the negative. Looking at the RSI and the CCI, right? We've talked about we talked a few weeks ago that the correction started over here when we finally broke below the minus 100 on the weekly CCI. Well, we're still below minus 100. We haven't broke below 40 yet on the RSI, on the weekly RSI, but we are below 40 on the daily. We're still in bearish mode, clearly bearish mode here. The Ichimoku cloud is still clearly bearish. We're well below it. We're just starting a new bearish trend. It's still weak. It hasn't even gotten back to intermediate trend strength yet. Of course, the Russell 2000, we never ended the bearish trend. It's unbelievably mature. I mean, that's a hugely bearish trend. The rate of change is unbelievable. This 26-day rate of change, which is what that red line suggests. Let me show you. You may visualize that here for the Russell 2000. Let me come over here and make it. Oh, it's 26 days. So we're at 10%. That's how far below that red line is below the price. Let me kind of give you some perspective on that. That's a pretty low level that, again, we only see during corrections. We saw that multiple times in 2022. Another time during the banking crisis. But what's interesting is we've had now 61 days since July 31st, 61 trading sessions. So if you go to the rate of change since that July 31st, the highest close we've had, we're down 17.5%. We're actually down more now than we were then. In fact, we're down now more, about as much as we were some of these other levels in 2022. We are clearly bearish. And if you look at SPX, it's even you think, oh, we're only down 8.75%. That's not 10%. But if you look at, again, over 61 days, by 61 days, we should be back to being positive again. The fact that we're, or at least, slightly negative, the fact that we're this negative, again, goes to show that there's still some negative left to go with this amount of time, over this period of time. The fact that we haven't bounced back up, suggests a failed pullback bounce. We should have bounced back up, over here, but we just didn't. And so, that's another sign. And you look at the Bollinger Bands here. We are back below the lower band. Still in, even with today's move, you are just barely above the band. Yesterday's bounce stayed in the lowest quartile, but you're below that lower band again. The bands are about another day away from getting green dots as the negative momentum reemerges over here. Very weak positive. Didn't even get green dots on that positive momentum move. So you can see the positive momentum moves have been getting gradually weaker, and weaker. And that's, again, a sign that we're going to be bearish here for a while. Before I left, we talked about this sign right here, that we got this. It was the day before right here. We talked about, okay, we're going to have one day, the next day after I left, we're going to get this up to either 100 if we got a new high on the 18th, or at least up to the second highest level, which is 94.7. Well, it didn't get a new high on the 18th. We just dropped. We kind of gapped down and just kept going. So it's another one touch, but it, not quite at 100, but pretty close. And then I mentioned to you that I felt I was more likely we'd get a new 4-week low before we got a new 4-week high. Well, that was the case. You can see that here. Monday we got a new 4-week low point. Today we got it again, right? We got a new 4-week low point again. We're already below Monday's low. It appears that Monday set the high for the week. We tested it a couple times Tuesday, but it appears Monday set the high for the week. We're already below last week's low point. It's a lower high and a lower low today, clearly closing below. We're below the value area for the 4 weeks. The range is really small, right? So it's not like we're like extremely volatile right now. The range is really, the 4-week range is really small. It's like it's below 5%. So it can actually, again, when you look at like what it does during corrections, as you saw over here, it expands out to above 10% during actual corrections. It hasn't done that yet here, but you expect that it probably will get up to that above 10% sooner rather than later as we actually full on go into this correction mode. Looking at today's volume and trading range, you can see above average volume, or slightly below average range. You see that ATR is really grinding up to the upside. 1.5% is the target we've talked about during pullbacks that we generally get to. We haven't even got to that yet. I mean, the volatility just hasn't been there. The VIX is barely above 20, like it closed at 20.5. It's not even above 95%. It's clearly not above 1%. But, and you can see the VVIX is at 102, so it really came down too today. But if you look at like where the VIX is closing relative to its average values, like we're above the 30-day average is crossing above the 200-day. If you look at the longer term here, the weekly version of this, the 8 and 17 have already crossed above the 30. Like we are clearly in a different mode for volatility, similar to back in December. Right over here, when we started the correction, we kind of broke out with a strong week of volatility there. You can see the 8 and 17 cross the 30 there. You can also see going back again to that 2022 level. That was the same time too that the 30 crossed the 200 back in December, and you can see the 30 stayed above the 200 all the way through for the most part. One little brief turn in August before Jackson Hole wiped that out, and then we bottomed out in October. Well, so the state, I mean, that's a new volatility regime to the upside. Well, here we are, 30s crossing above the 200. We haven't gotten above. I mean, back then in December, we got above 100% to VIX 3M easily. We got above 30 on a close here. We're barely getting above 20 right now. We're barely getting above 95%. Like we have not even come close to seeing a volatility event yet, even though we are in a new volatility regime with these averages changing and clearly in correction mode. So this is going to be very similar to the 2018 correction, where it starts slow instead of starting hard like a lot of pullbacks and corrections do. This one's starting slow, and then like 2018, the event will come at the end, and then we bounce off of that. And how much we bounce, of course, remains to be seen, but that's the type of correction that appears that we're headed towards, is that slow moving that eventually, and you can see it, what it looks like over here. If I were to zoom out and you go back to 2018, this fourth quarter, see, we actually did get above, barely above 20 then too. And so you can see it really wasn't very much of a, at the very beginning, we got above the 200, the 30 crossed above it, but we kind of stayed around the 20 until at the very end is when you broke out. There, and you finally got above 30. And the same thing happened on this chart, where you finally had, here, let me move over to daily on this, where you finally got in the fourth quarter of 2018. I had to go back more than 5 years. Been that long. So over here, so you got above 20. You actually did get above 105% easily on that initial burst, even though you weren't that far above 20, but the real burst came at the end. You got above 125%, which is kind of the level. That 125 is, what you get to during corrections. You saw that here in 18. You saw that in COVID as well. We never even got above 105% really in 2022. Didn't even come close. And so we still have, and we're again not even above 95, much less above 100. We haven't had our volatility event yet, and when that comes, considering how we're already below the 200-day moving average, you have your biggest moves on the markets generally below the 200-day moving average. You have a lot bigger moves than below. You can see the type of moves that we've gotten. Like we haven't had a 2% down day yet. The last time we had a 2% down day was 12/15. Well, that's the S&P. The Qs have had their biggest down day today since 12/15 of last year. You can see right on par with what we saw in 12/22. But essentially, this was our biggest down day today that we've seen since this entire year, this entire calendar year for the Qs. And so once we start to get that volatility pick up, as you can see here, like again going back out to that fourth quarter 2018, right in this area again, we started off with a couple of down days and it was pretty quiet until the end. Then we had all these big 1%, 2% moves at the end, and the VIX peaked. That's the kind of market I'm expecting this go around. Like we're going to start to see 2% down days now that we're below the 200-day, and that's when people are going to start to be really uncomfortable if they haven't already. Remember, the Russell 2000 is in correction. You could argue it's actually in bear market mode already, but it is in correction. It hasn't had very many 2% down days yet, like it did during the correction of 2022. So, it's coming. These kind of moves are coming, and just because we haven't had them yet doesn't mean that we're not starting as I showed you with all these other signals, that we're not starting a correction. That just means that they're going to come towards the end. We're going to build up into them instead of starting with them like we normally do. All right, now let's talk about what's driving a lot of this price action. You can see over the past 3 months, gold, the dollar's been up, yields have been up because bonds have been down the most, right there with real estate and small cap stocks. Commodities have been outperforming. That's your three-headed monster, right? And if we go back to starting the day after I left here, since we really kind of were on that cusp of either, just taking off to the upside or, failing and starting this correction, with the latter being kind of our expectation. This is what's happened since then. Gold and commodities, the dollar's been better. Yields have not been that bullish. That's kind of, they have been up. They're up, TLT's down 2% over this period, but it's not, their yield stocks are underperforming bonds. Yield bonds are actually up against stocks, which hasn't been the case before. And so it's interesting to see that it hasn't been that big of a move higher in yields that has prompted the Qs to be down 5% since I left, or 6.5% for IWM. And if you look at today alone, just today alone, you can see again the three-headed monster. Yields were up, commodities were up, and the dollar was up. That's your three-headed monster. Gold was up today, which again kind of goes to show when the dollar and gold's up, that's safety right there. That's about as safety as you can get. The Qs were down big, 2.5% today. IWM was down quite a bit. SPY was not down as much. The Dow I think was only down like 1/3% today. And you can also see high yield, right? So when you take a look at, it's funny to see like XLK has been outperforming. It's been on a nice little relative strength run, though it's definitely losing momentum and rolling over now. But it's still outperforming the rest of the market here, even as it's starting to turn bearish. But when you look at the ratio of the Qs to IWM, you can see like even though we're in convergence mode, it's still easily above these moving averages, way up above the 50-day moving average, as we're starting, like I said, converge, and that correlation still is strongly negative. If you take a look at high yield relative to IEI, which is the corresponding duration, now you can see that correlation was slightly negative. It's starting to turn higher as we are moving lower in this as the 30-day is crossed below the 50 now. The 8 still below the 17. They're still below 30. We had a nice little rally over 2 days in high yield, but today being down, and you can see the long-term PPO is falling. Like that's a ratio again that is correlated to the markets. Another ratio that hasn't been necessarily confirming the bearishness recently is the ratio of discretionary stocks to staples. They've stayed pretty high. In fact, the correlation went slightly negative because even though the markets have been weak since that end of July, this ratio has actually been pretty positive. But that finally broke down too. So, and the correlation's turning positive, and you can see the RSI is almost below 30, and look at the MACD breaking down hard, and long-term PPO is finally falling. So even that ratio is starting to say, okay, we're starting to get a little bit bearish here to the downside, which is funny because sentiment, when you look at sentiment here, even though the breadth has been horrible, the sentiment has not been that bad. In fact, the sentiment was really strongly bullish here earlier, and we didn't going into that July 31st peak. It was pretty strongly bullish, and it broke down a little bit, but like this past week, it was at 0.5. The difference between the bulls and the bears on the AAII survey. The MACD is like barely negative at all. Like you can see how negative it gets during a correction. You can see how low these lines get, the averages for these down here, how low they get during a correction. And they're barely negative. The averages are barely negative. The actual surveys, so sentiment's not that bad, even if the breadth is this putrid. Like the new highs and new lows is below 1,000, and the average now is back below 500. Again, that only happens during corrections. The number of stocks above their 50-day moving average, still easily below 150, well below 70, like below 100, below 75. So pretty bearish there. And then when you look at and then again, when you look at it on a weekly basis, just how bad that is. We're still way down there. And then you look at the 200, the number of stocks above the 200-day, we're finally broke below 150. The average is breaking below 200. I mean, these are clearly bearish levels that when you are in correction mode levels. I showed you before that, that when you look at this chart, the zigzag, it actually kind of looks like it's not a correction, that it's still just a pullback. 8.76 is kind of pullback levels. But when you look at it over the course of 60 days, then that's, a correction. And it's kind of, again, on line with what we saw in fourth quarter 2018, where we didn't really have that big of a drop here, 9%. They're not that big of a drop until the end. And that's when you had, right, so when you go to that 10, when you look at it, the zigzag here on a 10% level, that's where the bulk, so that was a 19% decline, but the bulk of that came at the end, and that appears to be what's going to happen here. We expect you'll probably be around, I expect you'll probably hit the March lows. I think I've told you before. I expect you'll probably hit the March lows for the extent of this correction. That would actually get us slightly below the 200-week moving average. Which would be very typical for a low point of a correction. So right here to the March lows, a little bit below the 200-week moving average there. That there's some very strong support from a Fibonacci level at that 38% Fibonacci retracement, the 23% retracement of the full bull market run that we've been on since 2009. Very important Fibonacci, long-term Fibonacci levels there. Breaking below that, then you're going to be in bear market. I mean, you can see the lack of volume there. You're going to be in full-on bear market mode at that point. So very important. Very important that we just don't even get to that level, right? What do they say in football terms? When the easiest way to convert on third down is not even to get to third down. I mean, it's the same thing. The easiest way to avoid a bear market is not even to have that correction, just to stop right here and bounce back up. But considering that likelihood of that happening is small now, now we're going to be in correction. We'll kind of watch to see again towards those March lows, and then a bounce back up, however far that may take us, and then we'll see what ends up happening at that point. Let's look at the sector performance and how it's done here in the last little bit. So pull up the sector comparison. Obviously, when you look at the 12 grid for the sectors here, dark pink shading and a red line across the board, right? And we are full on bear market mode. Even XLC is turned lower. Still got light pink shading with XLE, but 51.99 has to get below 50 to get dark pink, so that won't last very long. The XLU is rising, but it's only at 34, so turning that down will turn it back to dark pink pretty quickly, like these others have. So, I mean, it's dark pink shading and a red line across the board here. You can see the clusters. As you see the breakdown with Google on XLC. Meta reporting earnings tonight, already rolling over after initial pop, losing a lot of its gains in the after hours. So now let's take a look at the comparison. And again, we'll go back initially to from the time that I left, and we were talking about, okay, we're probably going to start to transition while I'm gone into this correction mode. Staples, utilities have been your best performers. That's very typical. That hasn't been the case, right? Before, when yields were rising, these two really suffered. But now, yields are still rising a little bit, but they're still rising. Stocks are falling, but now those two are not suffering. That's pretty typical. Healthcare as well. You can see technology is actually holding up well. Energy was holding up well until here recently. But you can see like discretionary, materials and industrials, cyclical stocks, financials struggling, big time bearishness. And if you look at today alone, just today, you see Google's impact on XLC, XLY down 2%, along with real estate, XLK doing okay, but I mean, again, this is risk off. Very, very typical of risk off. We are in risk off mode, and it doesn't look like we're going to be ending that risk off mode. It looks like we're kind of just starting with the risk off mode. All right, now let's take a look at our trade idea of the day. Let's pull up Adobe. Adobe has been interesting. It really took off during that kind of earnings cycle. But then this last earnings cycle over here, but then this earnings cycle, it kind of peaked. The AI craze wasn't so crazy anymore, and it's pretty much sideways ever since then. This past earnings obviously didn't even go up at all. It's been more bearish, and you can see breaking below by almost 2% below the 30-day moving average. You got you got light pink shading because we're not quite below 50 yet, and we're not quite below the market sentiment, but you're probably a day away from that happening. That crossover there, this would be a very bearish intermediate peak. If it doesn't get above the 80th percentile, you're already out of bearish territory. You're probably maybe a day or two away from getting in the lower half of the chart with dark pink shading. Short-term sentiment's bearish. You can see the weekly chart is been converging, and you got this bearish near-term peak. We're already rolling over. The PPO has been falling pretty sharply down towards the 30-day moving average. So you can see it's running out of gas, right? It's had its move. It's running out of gas here. You look at the 3 green arrow chart. It got 3 red arrows today. You can see what that looks like here on this chart. Breaking below both the 30 and the 50 today. Easily below the 17-day. MACD is below its moving average. Is a day away from going negative. The stochastics in the lower half of the chart. I mean, clearly moving over, and you can see not much room to the down, not much support at all to the downside here at all. You look at the DMI, you've had a bearish switch over there, though we're not quite above 25 yet on the negative indicator, but you're not below 20 yet, but you do have that negative crossover. You can see the RSI and the CCI breaking down in the lower half of the chart, breaking below minus 100 there. And then you look at the Ichimoku cloud. You are below the cloud now. Didn't get below the cloud over here. Now you are below the cloud. The rate of change has gone negative. You're below that blue line. The bullish trend we had has hit 0. So things have changed, right? You look at the Bollinger Bands and the Keltner channel, and you can see again the bandwidth is not too high, but it's not at its lowest point either. We are in the lower half of the bandwidth, flirting with getting into the lowest quartile. And the bandwidth is already outside of the Keltner channels with the momentum declining and close to switching over. So considering the broader market trends, I thought, okay, let's do a pretty aggressive, relatively aggressive bear call spread. We'll buy and sell that 450. Again, that target is based off of the move for December, right? It's going out to December. So you're looking at about 447.5 or 1 standard deviation, but you can see that is smack dab in the middle of this area where there's no volume at all. So very easy for big moves to occur, especially below the 200-day moving average. Because if you notice, by the time if we were to get to 450, you'd be down towards that 200-day moving average, well below the 50, easily filling in that gap there. And as I mentioned before, you'd be breaking down. Here's 450, be right down towards the 200-week moving average. So a little bit aggressive here, and it's really cheap for the amount of risk we're taking. We're getting 5 times the reward. So that's kind of the idea behind this trade. It's a speculative trade. trying to take advantage of what is can be a very bad setup for Adobe in a market situation where we might be beginning a correction that may last throughout the rest of this quarter, similar, like I said, to 2018. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your evening, everybody, and we'll see you all next time.